What if the money in your bank account could decide for you what you're allowed to buy? This isn't science fiction. It's happening right now in Australia. Through Project Pine, the Reserve Bank of Australia is testing programmable money, currency that can expire, restrict purchases, and follow hidden rules. But this isn't just an Australian experiment. It's part of a global shift led by the Bank for International Settlements to bake rules into every dollar, quietly shaping the future of money. Think you'd never let a government or bank dictate your spending. You might not have a choice. Policy is being shaped behind closed doors, far from public debate, by international working groups and central banks. Stick around to see how this could affect your everyday spending and what you can do about it. To understand what's at stake, we first need to look at what happens when money stops being neutral. The death of neutral money. For generations, money simply served as a neutral tool, an instrument of exchange that didn't interfere with your choices. A dollar bill never asked questions or set limits. It was yours to use as you saw fit. This core principle is now under threat. Project Pine, the Reserve Bank of Australia's pilot initiative, introduces a new era. Currency that comes with built-in instructions quietly shifting money from a passive medium to an active agent in your daily life. Programmable money operates on embedded conditions. Imagine stimulus funds that vanish if not spent within a set time frame. China's digital yuan already does this with expiration dates designed to spur immediate spending. These aren't distant hypotheticals. The technology enables money to block purchases at certain stores, restrict spending on things like alcohol or gambling, or even prevent donations to particular organisations. With each update to Australia's banking infrastructure, these capabilities move closer to everyday reality. The transformation isn't just technical. It's a change in the very character of money, turning it into a compliance tool. Central banks frame these changes as progress. The RBA highlights smart transactions that could, for example, automatically deduct tolls as cars pass sensors. Singapore's e-dollar trials have blocked spending at unauthorised merchants. These systems aren't just about making payments smoother. They're designed to enforce rules at the point of transaction. Once cash fades from the landscape, and Australia's cash use has been declining to levels central banks consider low enough to phase out physical money, every dollar becomes programmable by default. The RBA itself notes that this evolution isn't just about digital payments, but about conditional digitisation, where money enforces rules automatically. Financial institutions are laying the groundwork, often without public fanfare. Publicly filed patent applications from Visa describe programmable money particles that carry built-in spending restrictions. MasterCard's blockchain division develops algorithms to automate compliance. The power to set these rules isn't in the hands of consumers. It's concentrated among central banks and corporations. The effects reach far beyond convenience. Money that expires can create false scarcity even when resources exist. Purchase restrictions reshape entire markets without new laws. Automated deductions remove any option for personal discretion. The very definition of money shifts from something you own to something you're permitted to use under conditions set by others. As the RBA itself notes, programmable money moves beyond digitisation into conditional digitisation, turning currency into an enforcement mechanism. But what happens when the rules inside your money aren't just technical details, but hidden controls that shape your choices, sometimes without your knowledge? The hidden rules of smart money. These hidden rules are what sets so-called smart money apart from every form of currency before it. Programmable money is designed from the ground up to enforce logic and restrictions automatically. Take the example of stimulus funds that disappear if not spent within 30 days, a feature already piloted in China. Or consider geographic controls. Money that works in one postcode but becomes useless if you cross a city boundary. These are not just technical tweaks, They fundamentally change how, where, and when you can use your own money. The Reserve Bank of Australia's approach allows these restrictions to be embedded at the system level. Instead of simply transferring digital cash, the infrastructure can attach rules to every transaction. Australia's new payments platform, for instance, already supports attaching conditions to transfers, a glimpse of how programmable money's logic is entering everyday banking. Internationally, payment giants like Visa and MasterCard are developing algorithms and smart contracts that let money check in real time whether you're allowed to spend it in a certain way or place. The Singapore digital dollar pilot automatically blocked payments to unlicensed merchants, while the European Central Bank's digital euro proposal includes spending limits for certain products. Once these rules are coded in, they operate silently, shaping every transaction without you ever seeing the logic behind them. Who decides which rules get written into your money? Central banks set the frameworks, but much of the technical implementation falls to private payment processors and technology firms. MasterCard's blockchain division, for example, builds smart contracts to enforce spending restrictions. Compliance is managed through a web of technical documents, regulations, compliance guidelines, and policy notes that rarely reach public debate or parliamentary scrutiny. This means the rules governing your financial life can shift quietly without your input or even your awareness. The effects go beyond individual inconvenience. Programmable money can nudge or block behaviours under the guise of financial wellness or public safety. A parent might welcome controls that block gambling, but those same mechanisms could restrict donations to advocacy groups or limit spending based on carbon usage. The system doesn't have to ban activities outright, it simply makes them harder or impossible to fund. In China's digital yuan pilot, welfare payments were tied to personal behaviour, and transactions with socially detrimental merchants were disabled. While Western central banks use more neutral language, their programmable frameworks enable the same level of precision and control. What makes this shift so significant is how quietly it unfolds. There's no headline act or dramatic policy announcement, just a series of technical upgrades, regulatory tweaks, and new back-end protocols. Each step normalizes conditional money until the boundaries of what you can do with your own dollars are quietly, irreversibly redrawn. But Australia isn't alone in building this new financial architecture. The design and rollout of programmable money are guided by a global playbook, one that connects central banks, regulators, and technology firms across borders, the global blueprint. Instead of acting alone, Australia's regulators are part of a coordinated international effort to redefine how money works. The Bank for International Settlements, BIS, often called the Central Bank for Central Banks, sits at the centre of this process. Through its innovation hub, the BIS drafts global frameworks called Global Best Practices that Australia helps shape and then quietly imports. These frameworks are built to be adopted with minimal public discussion, embedding sweeping changes into financial infrastructure before most people realise what's happening. Australian regulators don't just follow orders, they co-author the policy papers and technical standards that set the rules for programmable money. Once finalised, these standards are implemented domestically, often under the radar. The result is a system where reforms like real-time transaction monitoring, anti-money laundering controls, and digital asset frameworks are introduced as technical upgrades, not as public debates about the future of financial freedom. Each measure, taken alone, seems reasonable. Together they build a network of oversight and intervention, capable of monitoring and influencing every transaction. Globally, this blueprint is replicated with remarkable consistency. China's digital yuan enforces expiration dates and spending categories. The European Central Bank's digital euro prototype codes merchant restrictions into the currency itself. Nigeria's Naira blocks cryptocurrency purchases outright. The technical standards developed through BIS working groups ensure that, regardless of the country, programmable money operates on similar foundations: interoperable, enforceable, and centrally controlled. Private payment processors and blockchain divisions build the smart contract tools that central banks then roll out under BIS guidance. Companies like MasterCard and Visa collaborate directly with regulators, embedding compliance mechanisms into the very architecture of digital payments. This partnership between government and industry enables controls that neither could impose alone, making the system more resilient and harder to challenge than any single actor could achieve. The rollout's carefully staged. Wholesale banking systems are upgraded first, followed by retail-facing features like payment expiry timers or automated spending limits. By the time the public encounters programmable restrictions, the underlying infrastructure is already locked in. The European Central Bank has openly acknowledged that this incremental approach helps avoid disruptive public debate, allowing profound changes to take root before most people notice. As these systems become entrenched, reversing course grows nearly impossible. Cash usage in some countries has dropped so low that physical alternatives can't be revived. In Australia, banking reforms are making traditional accounts incompatible with new payment rails. The BIS frames this as technological progress, but it's a deliberate policy, one that narrows the path back to neutral money. Financial pressure enforces compliance on a national scale. Countries that resist BIS standards risk higher borrowing costs, reputational damage, and trade friction. Australia's Treasury officials privately admit that deviation from the global playbook could isolate the country in capital markets. The incentive to align isn't just regulatory, it's economic survival. Policy documents reveal the true scope of these changes. The BIS envisions monetary policy enforced at the level of individual transactions, with automated fiscal controls shaping how, when, and where money can be spent. What starts as fraud prevention evolves into a tool for behavioural management, already visible in China's integration of digital currency, with social credit scoring and the EU's proposals for carbon-based spending limits. Australia's Project Pine is developing the same capabilities, just under different language. And all of these elements are already in pilot phases under Project Pine, making reversal increasingly difficult. The question now is what it means for everyday life when money itself can decide what you're allowed to do. Because the consequences aren't just theoretical, a financial dystopia. Picture trying to buy groceries only to have your digital wallet refuse the transaction. The reason? You've used up your carbon credits for the week after driving to work. This isn't just a theoretical scenario. It's a glimpse of the world programmable money could create. When financial tools enforce rules, access to essentials like food or housing becomes conditional, shifting the balance of power between individuals and the state. The system works by embedding behavioural limits into every transaction. Exceed your monthly meat allowance? The supermarket declines your payment. EU banks already share carbon data on transactions, and BIS papers show these feeds can throttle funds on high carbon purchases. This isn't limited to environmental goals. China's social credit system demonstrates how programmable money can quickly escalate into broader controls. Citizens with low scores are blocked from buying plane tickets or accessing certain schools, all enforced quietly through payment platforms. The same logic could apply anywhere the infrastructure exists. These restrictions don't require new laws. They're introduced through regulatory updates and technical tweaks, bypassing public debate. Individuals often remain unaware until they hit an invisible barrier, when a payment fails or a service is suddenly out of reach. Research confirms programmable systems can restrict access to necessities based on compliance with specific rules, turning money into a tool for behaviour modification rather than simple exchange. Australia's Project Pine may focus on interbank transfers today, but its architecture is designed to scale. The shift to retail wallets is already underway, making these dystopian scenarios the likely future for everyday consumers. Welfare payments, for example, could be geo-fenced or frozen if recipients don't meet government requirements. The technology to automate these controls is already in place, and once cash alternatives disappear, opting out becomes nearly impossible. Here, money stops being property and starts acting like a remote-controlled leash, one you never asked for. The erosion of financial sovereignty isn't dramatic or sudden. It happens line by line, update by update, until the boundaries of personal freedom are quietly redrawn. As programmable money moves from technical pilot to daily reality, the meaning of financial freedom is fundamentally altered. The conversation about programmable money isn't just technical, it's personal. When hidden conditions are coded into every transaction, financial systems can quietly shift power away from individuals. The RBA's Project Pine and similar global efforts are more than payment upgrades. They're reshaping the relationship between you and your money. Australians deserve to know what's being built before it's too late to ask why. If this worries you, comment below with your thoughts and share this video.